Hi, I'm here again with Dan Ivascyn, Group CIO, for an inside look into PIMCO's Investment Committee, or IC, and to talk about some of the key market and economic factors that are driving discussion these days. Thanks for joining me, Dan.
Thanks, David.
So investment ideas being kind of the stock and trade of the Investment Committee. Are there any other high conviction investment ideas you'd like to leave us with?
Sure. Well, we've been fairly active lately. We're a bit more diversified today than we've been in prior years. We've added some high quality bonds to portfolios as interest rates have backed up. So we're less defensive regarding overall duration exposure. When I look at and we look at risks across markets today, there's certainly elevated risks within the emerging markets associated with dollar strength and some uncertainty around the new administration's policies, particularly the degree in which these policies veer towards protectionism. But with that said, the good news about the emerging markets is that these risks are maybe not well understood, but they're on investor minds. And I think there are going to be pockets of opportunity within the emerging markets to help diversify more broad-based portfolios. From an asset class perspective, although you really need to focus on your bottoms-up analysis, we think there'll be some interesting longer opportunities there. We've been reducing some of our U.S. credit exposures across most portfolios. We've been going from an overweight to more of a neutral stance. I don't want to sound overly alarmist about U.S. credit. We still think there's a relatively low probability of a recession, and therefore we think defaults will remain low from a historical perspective, at least over the near term. However, we do have an economy that's near full employment, and we will likely see significant pro-growth policies go into effect. So this risk of overheating at some point and the need for the Fed to do a little bit more or perhaps even overshoot neutral policy rates has certainly gone higher. And under that type of environment, we want to be reducing credit carefully while still being cautiously optimistic long term. And we think we're going to have plenty of bouts of volatility this year to take advantage of the tactical flexibility that we've tried to build into our portfolios. And then finally, and I think it's important, given the recent trend in interest rates, to talk about inflation-protected securities. We continue to hold inflation-protected securities. We've been actively trading across the Treasury inflation-protected yield curves, but we like those positions from a secular or a longer-term basis, although they've done very well recently. And in some accounts that have had more significant overweights to TIPS or Treasury inflation-protected securities, we've reduced those positions a little bit as well. But it's in the context of a generally favorable long-term view on that particular asset class.
Great. Well, thanks for joining me today, Dan, and thanks to all of you for joining us today. Goodbye.